Okay, let's start. So, hello everyone. Welcome to 1402, Introduction to Macroeconomics. I won't teach today, so that's good news. I will start on Wednesday. So what I want to do today is essentially tell you what macro is about, macroeconomics is about, and also the rules of the game. So what a difference a single letter makes. Many of you must have taken 1401. In fact, some of you may be taking it concurrently. It's a lecture right before mine. And, that's microeconomics, 1401. This is macroeconomics. And it doesn't take a lot of imagination to realize that this course is about big things. No? We don't look at small things. That's what micro is about. Micro looks at a household, at a firm, at an industry. In macro, we don't do that. We look at the whole economy. We think about the US, we think about China. We don't think about an individual price, we think about inflation, so the rate of change of all prices. We don't think about whether a particular worker is employed or unemployed, we think of whether the rate of unemployment is very high or low, things of that kind. Okay? When we look at two countries, we look at the exchange rate, which is the relative price of two currencies, not two individual goods in two different countries, but the whole currency and so on. So that's what macro is about. Now, you could think that macro is nothing else than the sum of lots of micros. No? After all, that's what an economy is made of. A population, a whole population is made of lots of individuals that can be analyzed with the tools of 1401 and the sequence that follows 1401. But that doesn't work. And there are parallels in physics about this and so on. The way you want to study sort of big bodies is different from the way you want to understand the movements of small elements. And that's the case in macro. Macro, there's a big line of research that has to do with the micro foundations of macroeconomics. But even in that case, which is very close to micro, most of the action ends up...
Well, I've seen two people say that it's quiet. Is this quiet? I'm looking at my volume thing. It's literally like right almost at the red.
Happening in the non-micro part, in the interactions, in the equilibrium aspects of the system. So it's a much more complicated object, and if you were to build it from the micro, it would be an incredibly complicated object. So one of the things we need to do in macroeconomics is take some shortcuts. And that's what makes macro a lot of an art. It's not a science per se, it's some sort of a science, it has the tools of a science, but it's a lot about shortcuts and tricks and so on to capture the essence of a problem that is very complex if you were to model it in all the gory details. Okay? And in this course, we're going to exaggerate on that sense. We're not going to do anything complicated, I promise you that. Some occasionally conceptually things will be complicated, but the math will not be complicated, okay? So we're going to keep things very, very simple. I want to communicate the essence of the big macroeconomic relationships. This is not a PhD course. If you were to take a PhD course in macro, it would be a very mathy type course. In fact, most of the people that do apply in micro in our PhD program complain against macro because they find it too mathy and so on. Okay? But that's not going to be the case here. That's not what this course is about. My goal, so if this is a successful course, is not that you come out being a researcher in macro out of this. Hopefully you'll have a career eventually and do all the next steps that you need to do that. But I want you to be able to do is to read something like this. This is a World Economic Outlook. It's a publication that the IMF puts out every 6 months in which it tells you how it sees the world and where we're heading and so on. No equations there, lots of tables and stuff like that. I'd like you to be able to read that kind of document very clearly. I would like you to be able to read something, say, the Wall Street Journal, and read it even critically, sometimes disagreeing with what is in there. Financial Times, The Economist. That's the goal of this course. It's not a lot more than that. It's just that. If you do a summer internship in Wall Street and you work in a macro hedge fund or whatever, this is going to be a good course for that. I mean, this is what traders really know. They don't know a lot more than that. Many traders should know that, they don't. But that's the level of knowledge. If it gets to be very complicated, I'm failing. That's not what I want to do here. The typical lecture, again, this is not a lecture. The first lecture will be on Wednesday. The typical lecture and not in the first part of the course, because you're not going to have the tools, the definitions, and so on to do it. What I want to do is spend 5 to 10 minutes early on. Again, the first part of the course, we can do that because you don't have still the knowledge to do that. But as you start building tools, I want to be able to sort of talk about current events, something that is happening out there that I find interesting, or something I received that morning, may even the morning of the lecture, in which I find interesting. And if I think you already have the tools to begin to understand it, I'm going to be repetitive. I'm going to sort of come back to 3 or 4 times to the same topic. Hopefully, you'll be more advanced in your knowledge in the later stages, so you'll be able to understand it more and more. Okay? So the typical lecture will have 5 to 10 minutes in which we'll talk about some facts, something that is going on. For example, a picture like this. I received it this morning. I think this came from Goldman Sachs, yes. And what you have in that picture, again, don't worry about details today, is you have 2 lines. One of them is a measure of wages, wage growth, compensation to workers, and another one is a measure of inflation. Again, all those definitions will come in the next lecture. Inflation, so it's the rate at which, you must have heard about inflation. It's something, prices are rising, And what that picture shows you is that these 2 series are very highly correlated. Okay, so when wage growth is high, inflation tends to be high. Okay, and that's a big issue on these days. There's a lot of concern about this stuff. So let me try to explain a little bit what is a concern on these days. Again, if you don't understand anything, it doesn't matter. If you don't understand anything I'm saying right now in the last lecture, then it matters. But now it doesn't matter. I'm just trying to give you a flavor of the kind of things we'll be talking about. That picture there, again, a variable that we'll define in the next lecture, not now, shows you the unemployment rate. You don't need any specific definition to know that, to feel at least, get a sense that, well, if unemployment is high, workers aren't very happy. It's not a good thing to have lots of unemployment. And what that series shows you, the shaded areas are recessions in the US. What that series shows you is that typically in recessions, unemployment goes up. So that's one of the features, one of the main features of a recession is that unemployment is high. This episode here is called the Great Recession, as a parallel for the Great Depression. The US had the Great Depression in the 30s. This is the Great Recession, the biggest sort of recession outside of the Great Depression in the US. And it's also known as the global financial crisis, because this was a recession all around the world. And what you can see is that unemployment went very high. That's a very feature, a telltale sign of a big recession. And then it took a long time. This was in sort of recovering. COVID was a massive shock to the labor market, so not surprisingly, the unemployment rate spiked there. But then it also recovered a lot faster than it recovered from that. And today, we have unemployment rates that are at historically low levels. And that's a big issue. The rate of unemployment in the US is at historically low levels, okay? Way below what is normal. Forget recessions, obviously way below what happens in recession, but even way below what is normal, what happens during normal times, okay? Closely related to that is wage growth. I have just one measure of wages there. It's a series of wages that is particularly, what I'm about to say is particularly sharp, which is the wages in the accommodation and food service sectors. So wages have been rising very steadily and very fast recently everywhere, particularly in sectors like this, where we have some problems what we call labor supply. But I'll get back to that. Okay, so those are 2 facts. We have unemployment at extremely low levels, and we have wage growth at a very fast pace. Now that sounds wonderful, no? I mean, what else do you want? An economy in which there's few people unemployed and the wages are growing a lot. I mean, if this was micro, this would be fantastic. Say, okay, look, the guy is employed and he's getting a high wage. This is great. Well, not so fast for macro. Not so fast because I already showed you in the first picture that I showed you to motivate, there's a connection between wage growth and inflation. And that's what we're experiencing. The normal level of inflation for an economy like the US is around 2%. That's normal. That's what central banks target in an economy like the US, in the euro area. Japan has been dreaming with 2%, but it hasn't been able for decades to get it, but although now they are, but they weren't for a couple of decades to get to 2%. But that's about, and we will discuss later in the course, why 2% is about right for economies of the size of the US and so on. Obviously, in recessions, these things can go low, and that's what, in the COVID recessions, inflation went to zero, essentially. But then it began to pick up, and it's now at levels which are unheard of in the US since the 80s, okay? So depending on the particular measure you use of inflation, it's around 6.5% to 8%. That's the level of inflation we have, which is way, way above what is considered a normal, a reasonable target for the central banks for the inflation, okay? So that's a problem. We have had some good news recently in that inflation clearly peaked already. Again, definition of inflation, formal definition of inflation happens in the next lecture, but it already peaked and it's declining, but it's still at very, very high levels. And that's a problem. That's a big macroeconomic problem.
Is it 2% variation or 2% constantly? It's a rate of change. Inflation is generally measured as the rate of change of inflation. So when they say there's 2% inflation, that means it's going up 2% year over year over year. Hold on, let me get a drink.
And one of the things we want to understand in this course is, well, what to do about it? How do you deal with that? What do central banks need to do in order to deal with that? Now, I've been talking about the US, but this is not specific to the US. This episode, this recovery from COVID, is incredibly common across different regions of the world. I mean, you see it everywhere, with a few exceptions, and I'm going to talk about one major exception in a minute, but it's widespread. It's a widespread phenomenon that, we had high unemployment, then we had sort of very high, well, I haven't told you that part yet, but then we had sort of low inflation, then inflation picked up enormously, and now we're all worried about these very high levels of inflation. In fact, if you look at sort of what happened between the Great Recession and the COVID recession, it was pretty normal to have 70 to 80% of the economies in the world having inflation levels at or below 2%. Okay, so that's the norm. If they throw you into a country, if they drop you into a country, the normal thing would be, well, it's about 2%, that's the level of inflation. Obviously, if I drop you in Argentina, you're going to find a much bigger number, 10,000%, but the bulk of the countries were around 2% or so. Today, you don't find any country with inflation below 2%, okay? Not even Japan, that for years were in deflation and trying to get sort of above zero. That's what all they wanted. Not even in Japan you have inflation below 2% today. So this thing I show you, and for more or less the same reasons, is happening everywhere. Not exactly the same factors, it's the same episode, for example, and then with differences depending on the structure of the economy or in additional shocks. In Europe, for example, they had very high inflation, but the problem is not the origin of the problem. The bulk of the problem is the same as in the US, but at the margin they are different. In Europe, the big driver of inflation, the big recent driver of inflation, is unlike the US, which is aggregate demand, a concept you'll understand later, is essentially the war in Ukraine. That has increased the price of energy, and the price of energy has led to lots of inflation. So there are different reasons, but all of them are sort of different reasons that you add on top of what is a common story, which is that we overheated coming out of the COVID episode, and now we're struggling with that. Now, the main tool, and we're going to talk a lot about this in this course, the main tool that central banks have to deal with inflation is the interest rate. Okay? So for reasons you'll understand later, although you may have an intuition about some of those now, obviously when the central bank lowers the interest rates, then that helps the economy to expand, and when it increases interest rate, then it does the opposite. Rising interest rate makes mortgages more expensive, makes everything more expensive, so people tend to consume less, firms tend to invest less, and so on, because it's more expensive to invest, to borrow, to do something, okay? And there you see it. I mean, this was the level of the interest rate in the US before COVID. When COVID came, boom, they brought it all the way down. it happens that you cannot bring interest rate a lot lower than 0. That's the reason it stayed close to 0 there. We're going to talk about that later on. But then eventually they realized that we're behind the curve. Inflation had picked up a lot, and the central banks were behind the curve. So they began to hike rates in a hurry. Okay, and that's what we have been experiencing for the last year or so. Okay, very fast increase in the interest rate. Now, this is of course about macroeconomics, but I happen to do a lot of research between macro and finance. So I'm going to put a little bit more of a component of finance into, I think I'm going to do most of that in the last third of the course. But monetary policy has lots of implications for finance, for equity values, for the stock market and stuff like that. So what you see here is this line here is the SPX 500. It's the index, the main index of equity in the US, of shares, okay? And there are several indices, NASDAQ, S&P, Dow, and so on. This is the main index, the most comprehensive, the one that takes the largest companies, and so on and so forth. And when you can see what happens here is that when COVID happened, the surprise that we had really a pandemic, then the stock market crashed, declined like 30% or something like that at the time. And that's interesting of assets. I mean, that's one characteristic of equity that I like a lot. Other risky assets as well, but that I like a lot. They anticipate what happens. What happened there is the stock market, the shareholders realized that something big was negative and big was happening in front of us, so it was time to sell, and so the equity market collapsed. What happens next is even more interesting for a macroeconomist, which is this big boom here. It's an enormous boom. The economy here still was at levels of activity below what it had before COVID. But the stock market, the value in the stock market had way exceeded the level we had before the pandemic, okay? And the main driver of that, I've shown that in some papers, the main driver of that is not, I mean, people tell lots of stories, Amazon and so on, but Tesla, blah, blah. If you look at the aggregate, the main reason for that rise was monetary policy. You can explain all that increase in the equity value in the US, of the index, not individual shares, of the index, by the effect of interest rates, okay? So monetary policy plays a big role. If you care about finance, well, it plays a huge role in the value of assets. When monetary policy is very loose, that tends to increase the value of assets. And that's one of the mechanisms the central banks use to expand aggregate demand when they want to expand aggregate demand. They want people to feel, if you are in a recession, you want people to feel richer, so they spend more and so on and so forth. What happened here? This decline, you can also explain it fully with the hike in interest rate. Remember I showed you that the interest rate began to rise very rapidly here. Well, last year, the equity market in the US and most major equity markets around the world declined by 20% or more. You can explain all that decline simply by the increase in the interest rate. So that's another thing we need to understand is why is it that the interest rate matters so much for something like equity? So we want to value assets and we want to see what is the effect of the interest rate, and then we want to think about, well, why would the central bank worry or not worry about these things, and so on and so forth. But the truth is that financial markets and the central banks interact all the time. I mean, if you are, into Wall Street type thing, you're going to be watching every day, every time that the monetary minutes, the minutes of the central banks are released, you're going to be watching because it has a big implication for the value of your equity. Actually, something very interesting of this nature happened last week. On Friday, last Friday, there was a release of payroll numbers. So it's an employment index, okay? Employment numbers. And people expected the payroll to increase, so to add non-farm payroll, we'll talk about these things later, by about 190,000 workers. At 8:30, well, and this you're seeing here is the behavior of the same index I showed you before, but the futures. So it's things you can trade before the market actually opens. The market in the US opens at 9:30 a.m., but you can trade futures since Asia times, okay? Anyway, so this is the path. It's all very quiet, tranquil. Everyone is waiting the release of this news at 8:30 a.m. At 8:30 a.m., Great news for the labor market. Not only, the actual change in the payroll was not 190K, it was over 500,000K. So enormous addition of jobs to the economy. And look what happens to the equity market. Boom, it imploded immediately. So this is wonderful news for the economy, lots of jobs. The equity market imploded as a result of that. Why do you think that happened? I already given you a little bit of the ingredients for why.
Why did it happen, guys? Raise your hand. I don't know if rising wages would necessarily be good for companies because a wage is a cost of doing business. I don't know, that's my guess. Wages go up. Not good for business because cost of business is increasing. I don't know, that's my guess. I have no fucking idea. Or there's some other thing but who knows. Good luck. It indicates the Fed will raise rates. Oh, that's like 2 steps ahead. Oh, that would tie more to the class. Oh, okay. Oh, yeah, true. So you're making a fuck ton of jobs, which means the Federal Reserve's not as scared about a recession. So because job growth is so much higher, you would cut investments anticipating a rate increase from the Federal Reserve. True.
For an answer in the previous slides. The reason I'm showing you this is because it's in 15 minutes, it summarizes all that I was talking about in the previous 30 minutes. Why do you think that happened? This is wonderful news. Why the stock market should crash like 2% from top to bottom as a result of that?
Because there's a lot more labor, because that gives a lot more supply of that thing, and thus it decreases the price because high supply.
No, but okay, that's an interesting. Okay, that's an interesting explanation. It's not the one I have in mind. The explanation says, look, that means firms hire lots of people, so the price, that means there's going to be lots of supply of whatever goods they're producing, the price of those goods is going to decline, and that's going to be bad for profits. That's the story you had in mind? Yeah. Maybe there's some of that, but I'm willing to bet that it's not the main thing. So the only clue I give.
I'm pretty sure our answer is right, but the only thing he's mentioned so far in this intro class is that the Fed targets inflation. I don't think he's mentioned at all that the Fed targets unemployment as well. So I don't know how any student would ever have the answer to this question unless you knew that the central bank, that the Federal Reserve has 2 goals in mind. You would just have to have like background knowledge, unless we're wrong on our guest answer, I guess.
Is that I already talked about these things 5 minutes ago.
Employment is very closely related to inflation rates.
Yes.
Up to 0.81. So this could be a result of expectations of continuing high inflation rates.
Okay, you are very close.
Closer, yeah.
One step more.
Yeah. Oh shit. See, yeah. So because high employment is linked to high inflation, which is correct, and then the next step is because. So that means that the Fed is going to raise rates, which is why equities would go down.
More. Yes. That means that. So.
He's making everybody in this intro class feel like an idiot. What an asshole.
Step more. Yes. That means that. So.
Higher interest rates.
Okay. There you are. So, what happens? The shareholders wouldn't have done anything if they thought that the Fed would not be able to see this data. But they know that the Fed also sees this data. They say, whoa, these guys are going to be worried because the economy is going to keep overheating. They're going to have to hike interest rates even more in order to cool down this economy. Okay? I already showed you that what happens in the labor market is very connected to what happens with inflation. The central bank knows that. And now you get this big surprise that means they're not really they're not being successful at really slowing down one of the main drivers of inflation. And so financial markets are very forward-looking. They say, whoa, this is coming. This only means that the financial markets were betting that the Fed was going to begin to cut interest rates in 4 months more or so. And if you look at what the forwards did there, what the market, you can extract what the market thinks. Right after this, it all got immediately pushed out to the end of the year. Okay, so it's precise. It's the anticipation that the central bank will have to do something. And so I thought it was very interesting for that point of view. Recessions. Well, look, and these are all very good news, but everyone knows that the Fed needs to cool off the economy. So despite the fact that we're getting good news now, people expect, the majority of people expect a recession in the US for this year. I'm not going to explain this graphic here, but these are forecasters, these are professional forecasters, and more than half of them, so the median of them thinks that there is a 65% probability that there is a recession in the US this year. Well, we're going to talk a lot about this. And probably we're going to be getting news about this while we're taking the course, so this is going to be a sort of picture that we're going to discuss extensively. And the reason for the recession is nothing else than the reason, so you ask this forecaster, why do you think we may have a recession? Well, because the Fed is trying to fight inflation, it's going to keep hiking interest rates, and at some point it may break something, okay? And that's the reason. But we're going to, all these things you are going to be able to understand very clearly, hope, through models. The last thing I want to say before telling you a little bit the rules of the game is that I said before that the story I told you about the US is more or less what is happening all around. You know, I was in Chile a month ago, I'm Chilean, and they have the same story. They start hiking interest rate a little earlier because they had more inflation than the US, but they're going through the same cycle. There is one big economy, the second largest economy in the world, that has not been part of this, which is China. China was very aggressive in the COVID policy, no? So zero COVID policy. So they really slowed down their economy. That's a consequence. They didn't want to do that, but as a result of a very strict COVID policy, they essentially shut down big parts of their economy for a long time. That, by the way, had big impact in the rest of the world through the network of production, the chains of production and stuff like that. That was inflationary in itself. That part is dissipating. But for their own economy, for the domestic economy, that really slowed down China.
How does hiking interest rates affect inflation? Well, okay, we're watching a macroeconomic course. It was dumb to ask me to explain macroeconomic concepts because he's going to explain it better than I can. But broadly speaking, the Federal Reserve targets unemployment. They want to keep it, well, they don't publish it, but they probably want to keep it around 5%. And they target inflation, and they want to keep that at around 2%. When inflation goes up, you want to increase interest because that decreases the amount of money, broadly speaking, from being spent in the economy, as the demand is driven down by the increase in posted interest rates, then the inflation will go down as well. However, when you increase the Federal Reserve, the federal funds, when you increase interest rates, it also drives unemployment up. As interest rates go up, less money is spent, demand falls, then people employ people less, there's less demand for labor, so that increases as well. So if unemployment is very low, so like 4%, and inflation is high, like over 2%, then you would expect to see the Federal Reserve raise interest rates to bring unemployment up a little bit and to combat inflation. And then there's the inverse of that. But the interest rate of what money? It has to do with, I don't fucking know, dude. I think it influences a few things, right? It's like lending rates of the Federal Reserve banks to main banks, and it might be treasury bond posted rates as well, or I don't know if one is a function of the other, but we just say the Federal Reserve, okay? That's all we just say that, and then we're good, okay? We just say the Federal Reserve. But I think it has to do with lending rates to all the main banks from the Federal Reserve banks. And also, I think maybe the treasury bond rates, I think. There you go.
An economy that, grew typically at 5.5% to 6%, a lot higher 15 years ago. We're going to try to understand why later on. But last year, I don't know, it was 3% or less. The numbers in China are difficult to figure out. They are not equally transparent to other numbers. But in any event, it's very clear that China slowed down a lot. And that policy recently changed. Okay, the zero COVID policy changed. And so there's great expectation that now there's going to be a big boom in China because they're lagging behind. I mean, in the US, when COVID began to dissipate, we got a huge boost to growth. And that's part of the reason we got all this inflation, is because we had lots of growth coming out of the recession that happened in COVID. And more or less the same is expected in China. And one of the big reasons behind those big bounce backs is, well, people are desperate. They want to spend on something. They want to go to restaurants and cinemas and stuff like that. And the other one is they have the means to do it because they couldn't spend on anything for a while, no? And so they can travel and stuff like that. So people expect, and this is a very large economy that suddenly sort of wakes up. You know, that's a big thing for China, but it's also a big thing for the world. You know, what happens in China doesn't stay in China. It's a big giant, so it moves. And for some countries, it's very, very important. In this picture here, it shows you what is the impact on different regions of the world, on the growth rate in different regions of the world, of an increase by 1% in the rate of growth of China. One of the most, obviously all the neighbors benefit a lot, but Latin America benefits even more. Why is that? Well, because Latin America produces lots of commodities, and China consumes lots of commodity when it's building and stuff like that. And so that's the reason, big impact on Latin America. So this is a piece of good news for the world, in the sense that activity will go up. But it's good news on average, but it may be too much of a good thing as well. Why? Because many economies are going.
Does 1 pp mean 1 percentage point? Why not just type 1%? Because typing in 1% increase or decrease is mathematically incoherent. You should be talking in finance, you use basis points, or in other places you might talk about percentage points or just points. The reason why you don't typically say 1% is because, like, let's say that I go from 50% to 60% on something, right? What was the increase? It's not 10. It's technically 20%. 50% to 60% is a 20% increase, at least in the percentages. But you would say, like, well, it was a 10% increase. So you say 10 points or 1,000 basis points. Points means the point increase, and percentage means a percentage increase. So when you start talking about percentages and the difference between percentages, if you say percentage as a percentage change, it gets very confusing very quickly. So you should be saying in finance basis points, or maybe in other places you just say percentage points or points.
Going through what we described before. They're trying to bring down inflation. They don't want more demand. They want less for now, because we're going to understand the connection later on how demand connects to inflation. But you want less. And now you're going to get this impulse from China, which is going to fuel more inflation. It's okay for China because they don't have an inflation problem. But it may be a problem for many of the countries that are trying to.
Basis points versus percentage points is just a scale change, like cents versus dollars. That's fine, but people tend to use people tend to use one at one place and tend to use others in other places. You're never buying a hard drive that's measured in bits. You're always buying a hard drive measured in bytes. Technically, these units are interchangeable, but you just would never, ever, ever buy a hard drive measured in bits, right? Just like, yeah.
Is this impulse from China, which is going to fuel more inflation. It's okay for China because they don't have an inflation problem, but it may be a problem for many of the countries that are trying to undo the inflationary consequences of the previous expansion, the expansion that followed COVID. Okay, anyways, but this is the kind of things we're going to be talking about. I said the course is not going to be mathy, but it's going to be all about moles. The next lecture is the most boring lecture of the course, I tell you in advance, because it's definitions. I need to go through definitions. At least I get bored. But the rest, there's always a little model, but simple models, okay? But the models are going to try to explain the kind of things I discussed today. So that's what this course is about. Is ideally, if we're successful, you're going to be able to read something like the World Economic Outlook, which will have lots of pictures like this, and you're going to be able to write a little equation, very simple on the side, to try to understand what is going on there, and to catch the mistakes as well, okay? The WIO has less mistakes than the Wall Street Journal, but you will catch mistakes. You'll see. You'll be proud of us.
Okay, we'll just do 2 of these for today. This is a 25 lecture series.
I expect that there will be many fun lectures in the sense that we're going to have, we're going to be discussing a little model exactly at the right time in which that issue is an important issue, at least as described in the newspapers. We are going through a very interesting time for macroeconomists. Inflation is unusually high. Something needs to be done about that. We still have problems on the supply side of the economy as a result of COVID, or as a result of the slow reopening of China. We have a war going on, which is affecting also the price of energy, and is particularly impacting Europe. And all these things the situation is very fluid. All of them can change at any moment. And policymakers are therefore paying very close attention to all these things. It's not a normal time. If you're a policymaker, macroeconomist policymaker, you are not sleeping a lot these days. And so I expect that we will have plenty of time to discuss interesting things and analyze them at a slightly higher level than you can do at this moment. Now, I also told you in the introduction that this particular lecture is not going to be of that kind. It's going to be very boring, in the sense that we need to start with definitions, and I don't know who likes definitions. I don't. It's very boring. Now, there is an interesting or a curious side of the definitions we're going to discuss, which is that if you were taking 1401 microeconomics, many of the concepts we're going to describe require no definition. They're obvious. I mean, if I ask you for output of a factory that produces cars, it's pretty obvious that it's a number of cars. If I ask you for the prices of those cars, it's pretty obvious what the price of a car is. Not so for macro, because if I ask you what is the output of the US economy, well, there's millions of goods and services that are produced at the same time. So what do we mean by output, a single measure of output? Or if I ask you about the price level or the inflation, the rate at which that price level is changing, well, what are we talking about? It's very easy to see whether the price of a car is going up, but if we're mixing sort of millions of different goods and services, then it's a little harder. And that's the reason we need this lecture, because it's a little harder than 1401, and we need to define basic things. But they have a trick, because you're summing apples and oranges. Not only apples and oranges, apples, oranges, health services, financial services, all of them in one piece. And so it's a little trickier, and that's the reason we need this boring lecture. We need to go through that slightly trickier definition of output, prices, and so on. Okay, so let me start with the most basic thing. Aggregate output. At the end of the day, whether the economy is in a recession or not, and so we don't like it or we do like it, depends on what is happening to output. Is output growing at the pace it used to grow, or is it growing less, or it's declining? Well, that's very important for macro, and to understand the health of an economy, the macroeconomic health of an economy. But we need to start by defining what we mean by output. And because it's a tricky thing to do when you're adding so many apples, oranges, financial services, entertainment, and lots of things that are very different, we didn't have a good way of doing that. In fact, the national accounts, as we know them in the US, is something that we have since the post-war period, in the late 40s, that we developed the technique, the approach to come up with a measure of aggregate output. Before that, we had measures, proxies, industrial production is very high, meaning that we're producing lots of cars, stuff like that, and but something systematic, like we have today, is a pretty recent thing. Okay, we call that NIPA, the National Income and Product Account. Income and product, that's going to be very important for macro, as you'll see in a minute. So the main measure of aggregate output is what we call gross domestic product, or simply GDP. You hear GDP, that means output of an economy. Why is gross and not net? You're not going to worry about that in this course. Okay? But that's, if you hear GDP, most macroeconomists wouldn't say output, they would say GDP. It's very short, it's efficient, and so on. Well, that's what it means. It's the output of an economy. But how do we define it? as I said before, it's much harder than when you have an individual good. By the way, most of the time I will say goods, but really it's goods and services. But it's very long to say goods and services. No? So whenever I say goods, I'm not trying to play any trick on you. I really mean goods and services. I just mean lazy. Okay? And most people are lazy that way. Okay? Now, what is the difference between goods and services? You're not going to worry a lot about that in this. No, you're not going to worry at all about that in this course. But just to get a sense, goods are things that, that are tangible. Services are things that are not that tangible. They're benefits that you receive from the task that someone else operates on you. So you go to the medical center, you don't come up with a piece of a machine to, they may lend you something, but you don't come out with an objective. You come out with a service provided by a doctor to you, okay? And the same happens if you go to a bank. You don't come with an ATM with you. What you come up with is the service of having done a transaction or deposit or gotten a mortgage or something like that. It's a service. If you go to a restaurant, again, what you have is an experience. People provided an experience to you. Things are a little tricky because if you do a takeout, well, is that an experience or is really the goods? So if you get into those details, which you're not going to get, it gets to be tricky. But just to get a sense, on average, a consumer in the US, 2/3 of the consumption is in services, not in goods. It's not sort of the bananas and so on that you buy. It's a lot of the financial services, health services, and entertainment, and things like that, traveling. That's where you spend most of your time. Having clarified that, you cannot forget that. From now on, I'm going to say goods. So occasionally I may say goods and services, but I always mean the same. Okay? Good. So how do we measure these things? So well, there are different ways of doing this. Something happened to my slide there. Okay, there we are. So suppose that you have an economy that is very simple. I don't need to tell you how simple this economy is.
For reference, when was this filmed? I think about a year ago. Or maybe a little less than a year ago. Oh, no, about a year ago, around a year ago.
It has just two firms. Okay, suppose that we have an economy that's very simple. It has two firms. One firm produces steel, and the other one produces cars. And the company that produces cars buys all the steel from the company. You as a consumer don't buy steel directly. The car company buys steel, uses to produce a car, and you buy the car. Okay? So that's our simple economy, and those are the accounts of the simple economy. So there you have, company one has a revenue from sales. It sells $100. Okay? So price of steel times steel is $100. The second company buys steel, uses workers, and sells $200. No? So the first question I ask you here is, well, what is the GDP of this economy? Here you have an economy that has two goods. Needless to say, a real economy is a lot more complicated than this. But you have two companies, and I ask you, what is GDP? So the obvious things that you could come up with is, well, I sum all the revenues. Okay? So that's the obvious one. The total GDP of this economy is 300. That's a sensible answer. Okay? At least at this moment, I would accept that as a sensible answer. In the quiz, I wouldn't. But here, it's a sensible answer. I mean, well, you ask me for what is the total output of that economy, I sum up all the revenues and sales. And that's 300. So is it 300? Well, or is it 200? I mean, that's another. It says, well, look, only the final goods perhaps should count because, this is the only thing that you as a consumer will ever see. It's this part, not that. Those are two sensible answers, and what I'll show you in three different ways is that the right answer is 200 for that economy. Okay? Not 300. The right answer is 200. So method one, and all these methods are used, and they're used to check each other to compute GDP. So method one is what I said here, is final goods. You said GDP is the value of the final goods and services produced in the economy during a given period of time. Notice that GDP is a concept of a flow. It's something you produce in a year. Okay, that's the reason you say GDP of the US in 2022 was, $23 trillion. It's in a year.
Explain? I don't know. He's explaining. That's why we're listening to the fucking class. If I had to guess, counting all of the intermediate sales would probably artificially boost your GDP, and it would just be pointless to count it, right? That like if I manufacture, it would be impossible to count probably for all the intermediary transactions that occur when you're producing a good or service, and it would be pointless to have it as such. That would be my guess. I don't know. I don't know what the answer is.
Okay, it's in a period of time. Okay, so that's one definition. And one way of making sense of this definition is, imagine that I give you the same economy with the same two factories, and now all of a sudden I tell you, you know what, I'm going to merge the two companies. So the car company will buy the steel mill or whatever. Well, if I now put together those two accounts now, I never see the steel because that's all happening inside the factory. And it's still the case that the economy would be producing 200 cars. And all that you would see is 200. No? Because I would put this thing together. There was a steel that this company had purchased from that, but now it's all inside. Okay, so if I put them together, then that steel there doesn't appear because it's all produced in-house.
Yeah, what if I was working at McDonald's, would I say the guy working at the burger, like the guy who works grill, is he selling the burger to the guy working window who's selling the burger to the guy who's bagging it who's selling to the burger, right? There's probably, I'm sure he'll have a way to account for this, but probably your final cost here, like probably encapsulates all of the, like all of the intermediate stages as well, right? Your final revenue here, because if I buy $1,000 worth of steel, I'm probably not manufacturing $500 worth of products. It's going to be at least $1,000, right? So I imagine whatever our final sale here is going to encompass every single intermediary stage as well, would be my guess, but I don't know.
And now GDP would be 200. Well, it makes no sense that just because I change the ownership structure of the companies, that your GDP changes, collapses from 300 to 200. If I only measure in final goods, though, I don't have that problem. It's still 200. Doesn't matter that I have the merge, slice in 20 or whatever. So that tells you that we're going the right way here because it's a very robust answer. That is, you don't count intermediate output, you only count the final goods, which are the things that the consumer will buy, the firms will buy for investment and things of that kind, that foreigners will buy. Alternative method is GDP is the sum of value added in the economy during a given period of time. What is value added? The difference between the final goods produced by a company and the intermediate inputs it purchased to produce those goods. Okay? So what is the value added of the steel company here? The answer is there, but but what is the value added? It's 100. How do I know it's 100? Well, because it's not buying any intermediate input, and the revenue is 100. Okay? So that's the reason I get 100 there. Okay? It's 100. There's no intermediate input.
Why do you keep spamming this in chat? Remember, GDP does not equal quality of life for the citizens. I don't think anybody's saying that. I don't think anybody said that. I don't know why you keep spamming this in chat.
What is the value added of the car company? Well, the revenue on sales is 200, but it purchased 100 in intermediate inputs. So the value added is 200 minus 100. The value added of this company is 100. 100 plus 100, I get my 200 again. Yep.
Can we consider the wages to be intermediate good?
No, those are not goods. Those are factors of production. Okay, so there are machines in that factory that are helping you produce things. That's a service of the machine, it's capital. That's not an intermediate input. An intermediate input is another good or service that you buy for the purpose of producing that good, okay? So workers is not. Workers are working inside your company and so on. If the work was outsourced, and you had another company that produces something that you use from those workers, that would be an intermediate input, but you would have to count the value added of the companies you outsourced to. You see? So that's method 2. And you see, we get exactly at 200. Those two methods are called production methods. There are different ways of measuring the production of the economy. The third method, and the last one, is an income method, which means, look, all that is produced has to be earned by someone. The workers, the owners of capital, somebody has to own that. If the firms sell collectively $200, those $200 have to be allocated to someone. Someone means workers, the owners of capital of the firms, or in realistic economies, the government. You pay taxes and things of that kind. Okay? We're not going to worry about the government for a while. So that's an alternative method. It's method 3. You just sum the...
Explained by work is different. When you're adding value to a particular thing, bro, I'm not going to answer too many of these because this is a formal class, so my bullshit, like informal explanations might end up being incorrect or something. But what he's saying is that, like, when you buy, I only know this because I read a little bit of that fucking Capital. What a horrible fucking read. When you buy a thing, you have some natural resource or you've got some good and you buy this and then you do things to it. So I have $100 worth of things and I'm doing things to it. I'm touching it, I'm molesting it, I'm doing whatever. And now I can sell this thing for $200. One of the things that you can do to this is labor, right? Or there are other forms of like capital that you could deploy to do things to this, to improve it so that you can sell it for more. Labor is just a cost of doing, is a cost of improving, basically. It's an input that improves your output, I guess. It's a I don't know if you would say productive input. I don't know if that is even a real phrase. So that's, but you wouldn't, it's just a cost of doing business. You're talking about Das Kapital or the Das Kapital, that 3-volume, horrible, atrocious fucking thing. And I just remember for the labor theory of value, it talks about natural resources plus labor plus whatever. Just, I only read like 100 pages of this book. Okay, fuck that. It was horribly written and boring, plus cringe.
Incomes. So who are the factors of productions here related to your question? In this, there is no government here, no taxes. So we have only workers and profits, the capital, the owners of the company. Wages is 80 plus 70, it's 150. Profits is 20 plus 30, 50. 150 in wages plus 15 profit gives you back your 200. Okay? So those are the 3 ways we have of measuring these things, and you see they give you exactly the same result. Now, there is something, aside from the construction of national accounts, there is something interesting in what I just said, which is, look, that production is the same as income. That's going to be very important for macro. Very important for macro. And it's totally unimportant for micro. When you're looking at a company, for example, in micro, and you're looking at a car company by itself, it is true that, the output of that company becomes income, part for the owners of the company and part for the workers. But that income needs not be spent in cars. It can be spent in food, entertainment, and whatever. Not so in macro. Because what else are you going to spend it to than in the same good that you're producing, in the aggregate good? So it's very interesting. That's a very distinctive feature of macro that is not present in micro, is that income has to be spent in the same goods. If the economy is closed, later on we're going to open the economy to the rest of the world, and then you buy some Chinese goods and blah, blah, blah. But if you keep it closed, hey, you are not going to buy cars, that's what you work on, but you're going to have to buy it in the single good of the economy, which is the sum of all the goods that we consume on average. That's going to be very important. Anyways, this time is this stuff move in the right direction. Okay, so that's that. Now you know what GDP is and the different ways of measuring. You're going to have to remember that for PSET 1.
Nominal GDP is the sum of, I don't know if you ever read these, but nominal GDP is the sum of quantities of final goods produced times their current price. Nominal always means in today's dollar. Wait, at their current. No. I just said that incorrectly. Sorry. Nominal is the things produced, or nominal always means at whatever it was currently listed at. So the nominal cost of a PlayStation or Nintendo 64 game was $60, right, nominally, then real is adjusted for inflation. So the real cost of a PlayStation or Nintendo 64 game, or a console game, I guess, has decreased over time, even if the nominal cost has remained the same, because as inflation happens, if it's $60 for 20 years, then the real price is decreasing, right? The production of most goods increases over time. The price of most goods increases over time. We want to isolate the first reason to measure how aggregate output grows over time. Real GDP, or just GDP, is the sum of quantities of final goods times constant, not current prices. We will denote nominal GDP by dollar sign Y sub T and real GDP by Y sub T. Okay.
And for quiz 1, and you might as well forget it for the future. It's good that you understand the concept, but it's different ways of constructing. It's not very important. Second thing we need to worry about is that whenever you're thinking about the output of an economy, you're really trying to think about the real output, meaning number of cars, the number of machines, and so on. But if you have inflation, for example, then the prices of these things are growing, and so the total revenue on sales is growing. But they don't mean the same, and we want to certainly separate these two things. And for that reason, we have a concept which is called nominal GDP, and another one which is called real GDP. Nominal GDP is the simplest thing on earth. Is essentially, we had only one final goods company there, which was cars, but imagine you have cars, refrigerators, many, many things. Nominal GDP is simply you sum all the final goods and you multiply them by their current price. And that gives you the dollar GDP that you have. I don't know what it is in the US today. You could check it, but it's $24 trillion, something like that. So that's it. P times Q, prices times quantity, and you sum across all the final goods. That's what you have to do. That's one way of calculating things. That's nominal GDP. But again, what we really care about is, we're going to care a lot about later on, is how that economy is doing over time. Is it growing? Is it not growing? Nominal GDP can grow for two different reasons. Can grow because the economy is really becoming more productive, is producing more goods, or because prices are going up. Now, at this moment, nominal GDP is growing very fast in the US, despite the fact that we may have a recession this year. We don't know. But nobody has any doubt that nominal GDP will grow because we have lots of inflation. And so you want to separate these two things. And the thing that removes the inflation component is what we call real GDP. And real GDP, if you hear the word only GDP, and that was produced by somebody that understands what it's talking about, GDP really means real GDP. Okay? If you just hear GDP, people are trying to say the output of the economy. Well, that's real GDP. And the real GDP is computed, there are many tricks, but essentially, what you do is you consume, you also sum across all the goods. You also sum across the goods, but you use constant prices, not the prices of that point in time, necessarily. Okay? So I'm going to give you a very concrete example. But before doing that, for this course, we're going to call nominal GDP, and all nominal variables are going to have, that's what the textbook does, they're going to have a dollar sign in front. So that's how we measure, that's nominal GDP. GDP is going to be Y, without the dollar. That's real GDP, okay? For the
Hold on. Let me go to the Mind Palace for a micro moment, okay? I don't know the answer to that question. Maybe it'll be figured out. I still don't understand why you would account for outsourced labor wages in GDP calculations, but not domestic labor wages. It's not really about domestic or outsourced. It's about whether or not the labor is sold as a product to somebody else. I don't know what the answer to that is. So let's say that I manufactured a product, I sold it for $100, and I paid $50 in wages. My GDP would be $100. But let's say that instead of let's say instead of selling a product for $100, let's say that I bought the labor from somebody else, and then I sold that same thing for $100. Then my GDP would be $150. Why should it matter if the labor is part of your actual firm versus buying it from somebody else? Well, let's imagine you have $100 of unimproved steel or lumber. I buy $100 of lumber, and then I apply $50 of labor to it, and then I sell that lumber for, I imagine I want to sell it for $150, we'll say. No, I'd want to sell it for more than that. I want to sell it, we'll say, for $200. $50 labor. The answer might just be because your inputs would be different, right? If you're buying the labor and you're buying the lumber, it would influence something. It's the answer somewhere down there, I think. The value added $50 on the firm you bought labor from also added value. Yeah, I think it would something related to that. There's an answer in there in the jumble of words I just gave out.
They're going to have a dollar sign in front. So that's how we measure, that's nominal GDP. GDP is going to be Y without the dollar. That's real GDP, okay? For the first part of the course, up to quiz 1, we're going to worry very little about nominal things because we're going to have prices completely fixed.
Wait, Josiah, do you want to hop into Discord real quick?
But you still need to know the concept. And that's real GDP. So now let me give you an example. So suppose you have this simple economy we had before. We're just going to look at final goods because that's what we need to look at to construct GDP. And so this economy produces cars. And suppose that it produces 10 cars in 2011, 12 cars in 2012, and 13 cars in 2013. But suppose that the price of a car is what you see there, 20,000, 24,000, and 26,000. Nominal GDP is simply the product, of this times that. That gives you $200,000. 12 cars times $25,000 gives you $288 and so on. That's nominal GDP. Real GDP, you have to pick which price you want to use, but only use one and don't vary it over time, okay? So in this particular case, we pick 2012, okay? So that means when you say real GDP at 2012, base 2012 or at 2012 prices, means that you're using the prices to 2012. You don't vary that. You let quantities change over time, but the prices remain fixed. So in this case, real GDP at 2012 dollars is 10 cars times 25,000. That gives you 240,000. 12 cars times 24,000, 288. This is interesting. For this year, nominal GDP is the same as real GDP. Why is that? It's an accident?
Because we use the base year as the 2008.
Exactly. We're using that's the base year. So that nominal GDP will always be equal to real GDP at the base year. That's the year we're picking as the base, because those are the prices we're using. What about 2013? Well, it's not 26,000 times 13, it's 24,000 times 13, so we get 312. And it's obvious here that real GDP is growing less than nominal GDP. Why is that? Well, because this economy has inflation. Price.
Okay, hold on one sec.
Bruh.
You understand what I mean, right? It's just the most softball crazy shit in the world.
Yeah. The ending was really, really sold it for me. I mean, she corrected him gently about, you lost the 2020 election. That was really the only time I saw real pushback. And then at the very end to be like, thank you thank you so much, sir. No, seriously, thank you for the honor. Thank you so much.
Like,
It's
it was one
that.
of the dumbest, most softball. Like, he would just say things that are just blatantly not correct. She'd kind of barely sort of correct it, and then they just move on to the next thing. And he even
Right.
and he still said it was a super harsh interview. And by the end, he was saying that, like, I'm treated very unfairly, and these are harsh interviews. And then it's like, what the fuck, dude? Yeah, whatever.
Yeah, how dare you ask me questions? How dare you say that economists say that tariffs are, going to be?
Well, it's not even about that. It's
going
also
to
about
raise
him
prices.
like just blatantly lying. Like, he just blatantly
To her
lies about
face.
stuff. Yeah, he just says things that are just completely and totally factually not true. Yeah.
And that's NBC. That's NBC.
This is
he has not been inaugurated yet.
The liberal media, bro. Go back and watch that
Right.
Kamala interview on CNN, where they were like, "What about in 2019? Where you said about fuck, what was it? Fracking. You said you were going to ban fracking. Oh yeah, I changed my mind on that. Okay, but you said this in 2019. Well, yeah, but I'm not. Well, what made you change your mind? Well,
Yeah, but
you
it's
know,
2024.
And it's
Yeah.
like, oh, and then meanwhile, Trump tweets like last year, I'm going after political opponents, and she's like, what about that? And he's like, I don't care, bitch. That was 2023. That was
yeah,
last year. Who cares? And, like, he literally like he
Right.
wrote this. And he's like, I don't care. I want to move forward. Fuck that. It's like, okay, based.
But in the way like what was the big one? Was it Obamacare? Like, he was all over the fucking place on Obamacare. He was
what
like,
the fuck?
He was like,
It was
he's
bad,
like,
but he made it better. But he didn't say how he made it better. But he tried to get rid of it.
Right.
But he also strengthened
But he
it.
but he wasn't gonna get rid of it because he strengthened it. Yeah, exactly. He took like 5 different fucking positions on that. So funny. And then one of my favorite lines of the night was when he goes, or was when she said, well, you did try to challenge it in the Supreme Court and get it struck down. And he said, yeah, but legally, not physically.
Yeah,
Like,
I legally I legally got rid of the ACA, but I didn't physically get. What the fuck? Is it a person?
yeah.
And then him saying,
he
like,
tried to-
I agreed with a lot of things in Project 2025, and I disagree with a lot of things, but also I didn't read any of it, so I have no idea what's even inside of it.
That's called the weave, man. It's
There's a
called the weave.
million different stupid fucking things that he said. It's like, what the fuck are we even? What is this? What is the point of this? This is so stupid.
It really is, bro. I mean, it's so embarrassing that this is where we are, and the grade he's like the curve he's graded on rather is just, it's insane. And
Yeah.
again, he's not been inaugurated yet. This is NBC. I can't imagine how obsequious it's going to get, after January 20th when he's inaugurated. And to your point, Kamala couldn't get away with half of this shit, a third of this shit. Like, she really couldn't. I mean, to your point, like about the fracking or transgender prison.
2019
Yeah, yeah, she can't change her mind fucking once in 5 years. That's like, how dare you, you lying bitch, And then he changes his mind every 5 minutes, and he's held to a different standard.
Yeah.
God, do you watch the full thing? I think I made it through
It was
3/4.
agony. It was gross. It was pretty gross. I don't think
What was the worst part for you?
Bro, I don't know. He didn't answer a single question, like anything. He was able to bob and weave through literally everything, and they would just move on to the next thing, even after blatantly lying over and over and over and over and over again. Like, the whole thing was just a joke. I don't even know. He still doesn't have a healthcare plan. They have concepts of a healthcare plan. They don't, like, we're still working on that. I'll tell you if anything comes up. Oh,
He's
one
only
of
been
my
doing it for 10
favorites-
years.
One of my favorites was he's like, Biden messed up real bad over the pardon stuff because he promised a position. I'm not going to take any positions on anything, so I'm never breaking my word. Like, wait, what the fuck? I'm not going to commit to anything here at all because I don't want to, be a liar. It's like, what, so you have no positions on anything? What the fuck are we even? What? It's just crazy. Yeah, Jesus.
Well, the plausible deniability bit's interesting too, because I don't know if this is the case, but I can already see the cope coming from, the Times, like, because he said Liz Cheney and Benny Thompson and the January 6th committee people should be in prison, and then he says, but I'm not gonna order it. I'm not gonna call for it. It's like, you stupid son of a bitch. We see this. This is the clumsiest version of plausible deniability that anybody paying attention will notice.
Somebody
So
definitely talked to him about that. Never, ever saying he's
Right.
directing the DOJ. Yeah. Mm-hmm.
Right, but he hired someone specifically that he doesn't need to direct to do. That's the whole fucking point of Kash Patel. Kash Patel's watching this, jerking off with one hand, scribbling notes with the other. Like, I got it. I get loud and clear, boss. I got it.
Mm-hmm.
He doesn't need to specifically order Kash Patel to go after Liz Cheney or whatever. And by the way, where were you on the preemptive pardons with like Liz Cheney and people like that? Now that Patel at least stands a chance at becoming FBI director. If you were Biden, would you preemptively pardon them or say fuck it?
I'm indifferent to it.
Oh man, it's crazy. This is where we are. It really is.
Yep, pretty
see.
wacky, pretty wild. The fact that he can just lie over and over again, also about like, oh yeah, I beat all those cases. Like you're talking to a convicted felon,
Right.
like he literally is a convicted. What do you mean? Why would you let this guy say this in front of you? Like, yeah,
Yeah, that it's. I don't know. I don't know what the media is exactly going to do for a second term, but it seems to me that they're going to be more inclined to normalize him than they ever were. I mean, obviously, obviously not to the extent that you're satisfied with or I'm satisfied with, but during his first administration, he had combative interactions with the media. I think we're actually going to see less of that.
yeah, of
I mean,
course,
if- yeah.
because
I think
the
we're-
left leaning media is worried about losing, I guess, viewership or audience to the alternative media sphere. All the alternative left media is basically full on like ready to ride or die with Trump. I watched fucking Jank with Paul, the PBD guy or whatever, or Patrick Bet-David.
Did you see Anna Kasparian? She was on Glenn Beck.
I haven't watched.
that?
I haven't watched that yet. I have it open in the other monitor. Jesus Christ, bro.
I can't. Yeah, that's what I'm saying. Like it's darkly funny, but it's actually quite depressing to see like how lopsided shit is. Because even with like you imagine a universe, a timeline, the multiverse where you and Hassan and Sam Cedar and Cenk and Anna, like everybody's on the same page, at least when it comes to Trump and the Republicans. Well, even then, I don't know the numbers on this, but you correct me if I'm wrong. Everybody's still outnumbered, right? I mean, if you take the collective left or the center left or whatever we're calling this, like anti-Trump coalition, versus the Daily Wire and their constituent creators and Tim Pool and Steven Crowder and Fox, and basically the funding and the viewership are still pretty squarely on the right as far as I can tell. Jordan Peterson, all these things, Piers Morgan, and we don't even have closed ranks on this. You have the Young Turks. I didn't see the PBD interview, but I saw Cenk tweet about the PBD interview and how inspired he was based on the conversation. He's like, all the hosts agreed to cut the defense spending and, do this. He said like 3 things he recommended. You have Democrats at least publicly signaling that they're going to try to cooperate with the Doge caucus. And I understand that to some extent they have no choice because it's here whether you like it or not. So I get why Bernie Sanders and Ro Khanna are saying, we're at least going to dare them to try to follow through on some of the shit that they've said that they're going to do, like cut wasteful spending. But the Cenk and Anna and I don't follow Hassan very closely, but I know he's being like normalized by CNN and Pod Save America. But my understanding was he didn't even endorse
No, he didn't.
Kamala Harris. But then like during the Pod Save America interview, he suggested, like he positioned himself in the conversation like he was pro Kamala.
No,
like
Hassan, he
us
functions
and
the same.
we.
They learned how the old Nazis functioned basically. Hassan is like the suit wearing Nazi guys in 2016 who like present themselves like the one guy from the think tank. Fuck, what's the guy's name? Oh, he's a really famous neo-Nazi guy. I don't remember his name. Richard Spencer used to be that. I don't know where he is politically now. Jared Taylor? Am I making that name up? Do you know what I'm talking about?
No, I don't. That doesn't sound
these guys,
familiar
but
to me.
that's kind of how
Richard Spencer, but yeah.
Spencer's, yeah. I think that this is how Hassan presents himself now. Yeah, Hassan is very good about like going on these shows, and since Pod Save America, these guys don't do any research on the people they bring on. They can't call him out on anything, so he just goes on and he's like very mask on, like, oh, like I'm just here, guys, because I care about like healthcare and immigration or something like that, and he just presents himself that way, and then he goes back to history and he supports terrorism, and he just
So he basically presented, one approach to John Lovett of Pod Save America, but would completely contradict it in his private streams, or in his solo streams, I should say, not
He
private.
doesn't. I don't know if I would say he totally contradicts it. He just speaks very, 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 very carefully about it. He speaks so carefully that he always can say like, "Well, I wasn't contradicting myself here." Basically, yeah.
Yeah, but that's what I mean. Like,
But
it's
in message,
just
yeah,
the
basically, it's contradiction. Yeah, go ahead.
Yeah, let's just that's what I mean. Like, you contemplate the political asymmetry and then the media asymmetry, and it seems to be getting worse because it seems like we're shedding major players on the quote unquote left. I know like a lot of people don't like Cenk or Anna, but the TYT's, it's a big platform, right? It matters that they're being so favorable. I haven't watched the Glenn Beck interview, but I saw her on multiple podcasts. She was on Piers Morgan. And I think she even says things. I know she said it in previous interviews, but that everything that's going, she says everything going wrong in her life, Republicans have nothing to do with it. It's Democrats ruining her life. And I just.
Here's what I'm curious about. Every single thing the Democrats did was overruled by Gaza alone. I wonder if they'll hold Trump to the same standard.
I don't think so. I think that it'll be interesting to see, but like I expect that they'll say, well, you know, we had different expectations for Trump, or Trump never pretended to particularly care about Palestinian lives. I mean, I'm sure people will still find a way to grade him on a curve, but that's where I was really impressed with Crystal Ball. I mean, I'm not going to lie. You know, yes, I'm trying to build bridges with, you know, between Kyle and the rest
When
of
she
you
was
and everything
arguing
like
with
that.
who?
Yeah, when she argued with Cenk. Yeah. When,
True.
you know,
Yeah, she trounced him on that.
No, yeah, and she did it, you know, even if you disagree with her, I think she did it without was totally sacrificing her disagreements with the Democrats and the Biden administration. I know you clearly don't share a lot of them, but she found a way to thread that needle. She's like, listen, I share a lot of the complaints you have, Cenk, but I'm not going to sit here. Like she said something to the effect of, even with all my complaints about Kamala, I have more in common with an establishment Democrat like Kamala Harris than I ever will with a Republican.
Yeah.
And she goes through like the National Labor Relations Board and Lena Khan and all these like
wins.
wins.
A specific thing. Yeah, Jesus, yes.
And that's why don't you have a conversation with him? Like you have a direct line with him.
With
And I think it'd be
Cenk?
really good. Like, yeah.
We've had multiple debates like this year, which just
Yeah.
always us screaming at each other. I mean,
Yeah, but this is him. Like, I don't think you guys have had one since he's like, I don't say gone full mask off, but since he swung his sail.
Gone MAGA, I think he's gone MAGA.
I mean, we can, but it's just going to be the same populist brain rot talking points. Like that's all it is.
But I say it'd be good content. He should be pushed on this even more by somebody like who would be even more pointed with him. Because the thing I want to hear is, how do you, when you compare records, how can you? I want you at least to confront the fact that the records are asymmetrical. Like, don't tell me, yeah, you understand. I want you to tell me, what has Trump and the Republicans, what have they ever done to match what Biden and the Democrats have done? I want you to concede, even if your whole strategy is to try to redirect them into some sort of like, I don't know, Aikido or Jiu-Jitsu move, whatever it is, like whatever the martial art is of like redirecting your enemy's momentum, like whatever that is politically, I want you to at least acknowledge that Biden was objectively superior to Trump and to every fucking Republican on labor. I want you to say that. I want you to
I
at
can
least
do it. I
acknowledge
just
the
whenever
reality.
I fight on, I'm gonna have to start reading a ton of because you saw this happen with Crystal Ball because he'll say that like, well, they're Pyrrhic victories. He's giving a little bit, but the donor class won't let them have the real wins. Like if Biden would have passed 14 an hour minimum wage, Cenk would be on the front lines talking about how much of a fucking failure it was that the corporate donor class tricked
wasn't
us
28?
at a 15 an hour minimum wage by pacifying us with a 14 an hour minimum wage. Like that would be like that's just it. There's nothing the Democrats do is good enough. And nothing that the Republicans do that's bad is bad enough. It's just fucking.
To me, like I take your point on the not good enough thing, and obviously that's almost secondary in the sense like we have to first get you to agree on the fact, or we have to fight to the death, proverbially, on this fact that Democrats are better, even if you think it's insufficient. That's fine, but I want you to at least acknowledge that it is a fact that Democrats have done better on this because. Anna, at least, I don't know about Cenk, but Anna, at least, seems to be taking the opposite approach, where either both parties are the same or actually Republicans are better. And sure. I think that, I don't know, I just think that he should be pushed on this, and Crystal's the closest.
I mean, he literally said that in retrospect, he's very optimistic, and that his mortal enemy was defeated, the mortal enemy being the establishment,
the donor class.
By Kamala. So how can you say you're more optimistic now because your mortal enemy was defeated if you haven't, in retrospect, changed your mind over which was preferable?
Yeah.
Any rational person wouldn't want their mortal enemy to win.
Well, and that's why, you know, when you talked about this on Live and Learn, I said that somebody like Steven's going to have to, again, just for clarity's sake, maybe he'll bite the bullet on that. But
if
for
any of the big
clarity's
debate
sake,
hoster people are listening, I'll argue with Cenk over who was better, I guess. Democrats or Republicans, I guess, policy-wise.
clip it, send it out into the ether. But somebody like Steven will have to put his feet to the fire and say, maybe you meant this. But if you didn't, you just need to understand that the natural and necessary implication of what you've said about the establishment is that in hindsight, you are glad that Trump
won.
beat Kamala.
Yeah.
What he's going to do is I supported Kamala. I said that people should vote for her. You have to say in retrospect, based on what you just said,
Right.
that your mortal enemy was defeated. And so you might have supported her in the past, but now looking back on it, do you acknowledge that Trump would have been superior than Kamala? Because that's the obvious, logical implication of what he said when he said my mortal enemy was defeated.
I'd also be interested, who's a bigger donor class than Elon Musk?
Seriously.
And Vivek Ramaswamy and
We
Bill
just ignore
Ackman.
that. No, just don't stop. We don't
Yeah.
talk about that. We just don't talk about the 10 whatever fucking billionaire, actual billionaire with a B people that are in Trump's cabinet. We just don't even think about that. What an absolute
saw a
fucking joke. It was a joke when Trump was the billionaire president, but now it's like the billionaire
supporting
president
it. Josiah
and
supporting it.
the billionaire cabinet. What?
Josiah saying that Bernie Sanders is based for saying that he should support like Doge. That's what Josiah just said.
So what Pisco's trying to do here, Stephen, is he's trying to redeem himself after the Merrick Garland shaming that he got
You
rightly.
just said that, yeah, we should work with
Yeah.
Elon Musk to like gut public workers and do all
Wait, do you support all the bootlicking that Sanders is doing, Josiah?
No, I think that what he has proposed to do is that he's going to bring legislation to the floor on one of the major proposals that they offered to basically get them put their money where their mouths are. I think that's the only thing you can do in a situation like that. Say, okay, you've proposed this thing,
Yeah, but
I
him
agree
and
with it.
Fetterman are saying like Elon's a great guy. He's like a
No, anybody saying that Elon or Vivek are great or good guys, no, that's ridiculous. But I think in a situation where Elon Musk and Vivek and all these billionaires are going to be like part of the oligarchy influencing Trump, the only card we have is, okay, they're here. We can't do anything about it. So you say you're going to do this, and this level of wasteful spending. Well, I think this is also wasteful spending. How about you put your money where your mouth is? I'm going to put legislation on the floor and get you on the record. I think that's the only card that even
I think
a
what we should do
responsible...
is we should take a book out of MAGA's book and we should identify the enemy. The enemy is MAGA and dark MAGA, the crypto billionaire supporters of Trump and MAGA itself, and we should attack them and identify them as the enemy. I think that's what we should do.
So many
Why should
MAGAs.
why should we be doing these inroads? First of all, it's so broken and stupid coming from people like Cenk, who when Biden
Yeah,
was
but I
making
think there's a
inroads-
meaningful, and I know you're memeing a bit, but just to clarify, I do think
I'm
there's
not
a meaningful
memeing.
difference.
What am I memeing about?
Oh, about Bernie bootlicking and me liking Bernie bootlicking. I know that's a
You
meme,
seem
but
to- well, I'm glad that you clarified, but I think that
were you not listening to a fucking word I said when we talked about this the other day?
Wait, where do you get this idea that Josiah's supporting Bernie?
No, it just sounded like you were saying I'm okay with Bernie doing what he's doing with the reach outs to Elon.
Wait,
Bernie's
did he
saying he
say
might vote
that?
for RFK. Yeah, wait. Bernie's saying he might vote for RFK. Bernie is being weird as fuck.
Bernie said he's going to do what? Vote for the election's over.
Senate confirm, I'm guessing.
Oh,
I heard that
that's
Bernie was
fucking
open to
stupid.
voting for RFK.
Oh, no, yeah, that'd be dumb. Why? He confirmed that?
I don't know. Is this fake news? Maybe it's fake news.
I mean, I haven't heard it. If that's true, that's insane. I listen. I don't. The only cabinet level person that I can think of offhand that I would at least understand Democrats supporting would be Marco Rubio, and not even because they agree with his policy prescriptions, but he's the only one qualified. He is the only qualified cabinet level nominee that requires Senate confirmation that Trump has offered so far that I'm aware of.
Yeah.
But RFK, fuck no. Even if you agreed with the whole,
I think what he's saying about food is exactly correct.
Based.
And to me, that's indicating like instead of going on and criticizing RFK and targeting RFK and making him public enemy number one, he's saying, yeah, he's right about some things. And that's what it sounds like they're doing with Elon.
Yeah, so I mean, we have to watch it, but I mean, Pisco, like you played the devil's advocate for Republicans and MAGA and like people we disagree with before. Like you're the type of person to call a spade and be public about it. So I don't have an issue with that with Democrats in theory doing it. It's just the level of support they give. If he starts foisting praise on Elon Musk or RFK Jr., yeah, that's sketch as hell, and I would totally disagree with that.
I'm sorry, and a lot of these people are based, and I like them. Like I like Moskowitz, I like Ro Khanna in other contexts. I voted for Bernie Sanders twice, but when you're giving cover to dark MAGA and this billionaire class of people who are trying to literally gut public workers and to like deregulate their industries, why are you doing that? Why aren't you calling them out 100%? Why are you pretending that they're going to cut military spending? They're not going to do that.
But that's to me that's
and they're charming you. Not you.
I understand. I know that's not what I'm doing, and I agree that that's what it looks like. That's what Cenk's doing. Certainly, what Anna's doing. I have not seen anything from Bernie or even Ro Khanna that suggests that they're there yet. Obviously, if it gets to that point, I totally disagree. I'm on your ass for the times you praise the Supreme Court because I think that the whole thing is illegitimate. But again, that's my point. I don't take issue. What's true? I mean, like in the sense, like
take issue with
I can,
Democrats
Also,
working
I have to
with
leave in like
Doge.
2 minutes, so go ahead.
I do take issue with Democrats working with Doge. I take issue with that.
There's
Yeah,
no,
so,
Doge
like,
has
Jared
no,
Moskowitz.
that's not even like an official thing, right? That's literally just like a piece of paper he wrote. Like there's no,
So-
is he going to authorize
well,
them
there's
by
two things.
executive or what?
Yeah. So, well, wait. So there's two things. There's Doge, which the actual, quote unquote Department of Government Efficiency, that requires, congressional authorization to become a full blown agency. But
Which is not
there's
gonna
the
happen,
Doge Caucus. There's the Doge Caucus, which is forming in the legislature. So they are forming a group within the legislature, not a committee, but a group that's going to be working
Yeah, a group of people
with
that
Doge.
vote, but they don't. But you say working
Yeah.
with Doge. Just to be clear, Doge is nothing. That's nothing. That Doge doesn't mean anything.
It will be something.
Sure, he might.
Well,
it's
not-
not going to be a full
not
government
le-
or office, right?
It'll be some office under the executive office of the president.
Sure.
And it'll
Well,
have power to the extent that
whatever he has the
are
authorization
listening
to
to
create, but it's not going to be like a full.
Well, so I think, well, it's interesting because I think there's some gray area because didn't the Bipartisan Safer Communities Act, that gun legislation, didn't President Biden and Maxwell Frost, I think they created in the executive branch, some sort of quote, I don't know if it's an agency or bureau or whatever, and I know there are meaningful differences, but there is some official group in the White House that is responsible for dispensing the Bipartisan Safer Communities Act gun legislation funds and all this shit and working with states. And Republicans I know have bitched about it because they're like, well, this thing wasn't authorized by the Senate. The legislation was, but the actual agency and the executive branch responsible for it, it doesn't have congressional authorization. So I think there is some wiggle room. But there's also, Stephen, a
you got
subcommittee.
20 seconds. Go subcommittee. Yeah.
The oversight subcommittee, there's one on Doge that's going to be led by Marjorie Taylor Greene. That's official.
Okay.
Fuck you.
All right. Yeah. Fuck him. God, I hate.
Wait,
this guy.
where the fuck were you going?
I gotta go. It's 9:30. It's my bedtime. Okay.
Well, wait a minute, just chill.
What?
What do you, just chill. Let's just hey man, how are you doing? I'm over here, you just kicking me out.
Yep.
You invite me into your home.
And I'm doing
We're
great.
chit-chatting.
Come by tomorrow morning. We can
having-
chat. Okay. At 1 p.m.
What do you
Okay.
mean tomorrow morning?
When I start my stream, not at the end. Okay. You're a late hawk. I don't know if that's
understand.
really. I love you. Be careful. Don't die.
All right,
Okay.
buddy. All right, see you, buddy. Bye.
Bye. Okay. We'll finish this starter tomorrow. Be careful. Rip on. Don't die.